If you've been following the news about Greenland and the escalating tensions between Trump and European leaders, you might be wondering, should I be worried about my investments in US stocks, both individually and in ETFs? After all, US companies currently account for roughly 60% of global indexes like the FTSE All-World, based on their current market cap. I've seen this question pop up more and more both in my comments and on Reddit, with some investors even worrying about their iShares or Vanguard ETF holdings somehow being frozen or seized if things escalate further. So today, let's talk about what's actually happening, try to separate the political noise from real investment risk, and figure out if we, as Europeans, should be rethinking the way we invest. Let me start by saying I get why people are worried. When you see headlines about 25% tariffs being threatened on European countries over Greenland, or read about military displays in the Arctic, it's natural to wonder, what happens to my money if things get worse? The specific concern I keep seeing is this. You hold ETFs from American companies like BlackRock, Vanguard, Invesco or Spider. If relations deteriorate, could the US government somehow freeze or seize European assets held in these funds? It's a reasonable question to ask. So let's walk through why I find this scenario to be extremely unlikely, not because I can predict the future, which I can't, but because of how the system is structured. First, we need to understand where your assets actually are. When you, as a European resident, buy a UCITS ETF, for example from iShares, Vanguard, Invesco or others, through a broker like Interactive Brokers Ireland or Trade Republic in Germany, here's what's actually happening. The ETF is managed by a regulated European entity. The fund is domiciled in Europe. The assets are held by a European custodian bank. The fund operates under European UCITS regulation, and your brokerage account is with a strictly regulated European institution. The fact that some fund providers have American parent companies doesn't automatically mean that your assets are sitting in the United States or subject to US jurisdiction. In practice, the individual stocks are typically held in the country where they're listed, which means US stocks are custodied in the US, German stocks in Germany, Japanese stocks in Japan, and so on. That's broadly how the global custody system is structured today. But here's what's important. This setup is identical whether you pick a fund manager with American origins like Vanguard or with European origins like Amundi or Xtrackers. The custody structure is the same. Now, let's assume for a moment that I'm wrong about the legal structure. Let's assume something truly extreme happens and governments start seriously considering actions like freezing foreign investment assets. Even in that scenario, it's important to think about incentives. Here's the thing about capital markets. They run on trust. If investors can't trust that their property rights will be respected, they take their money elsewhere. And once that trust is broken, it's incredibly hard to rebuild. Let me make this more concrete. Interfering with foreign investment assets wouldn't just affect one group of investors. It would raise serious questions for the entire global financial system. Large institutional investors, pension funds, and multinational companies all rely on the assumption that cross-border ownership rights are respected. If that assumption is broken, capital becomes more cautious, long-term investment slows, and capital becomes more expensive across many regions. That's why international disputes tend to focus on tools like tariffs, trade restrictions, or regulatory pressure. Those measures create leverage, but they don't cross the line into undermining the basic rules of asset ownership that global markets depend on. In other words, there's a very strong structural incentive for governments to argue loudly, negotiate aggressively, and even impose trade measures, but not to touch investment assets held under established legal frameworks. That distinction matters. From my perspective, and this is just my personal interpretation, what we're seeing here fits a familiar pattern in international negotiations. What's important for investors is separating political messaging from economic mechanics. It's also easy in moments like this to start thinking about markets in terms of us versus them, Europe versus the US. But from an investment perspective, it's important to separate political leadership from the businesses operating within a country. When you invest in globally diversified portfolios, you're not making a statement about governments or policies. You're owning shares in companies that operate across borders, sell products worldwide, and employ people in many different countries. The economic ties between the US and Europe are deep, long-standing, and far broader than any single administration or political cycle. That's why viewing this situation as a simple pick-your-side situation isn't very helpful for long-term investors. These agreements between governments don't automatically translate into companies being able to operate, generate profits, or to sell products. Large, globally active businesses have been navigating political tensions for decades across different administrations, trade disputes, and regulatory environments. Administrations change, policies shift, and trade negotiations move through cycles. Businesses like Apple, Microsoft, or Nestle adapt, adjust, and keep operating across very different political environments. That resilience is easy to forget when headlines feel dramatic, but it's a key reason why markets tend to be more stable over the long run than the news cycle suggests. That doesn't mean there are no risks. It just means those risks usually show up in earnings, valuations, and volatility, not in a sudden loss of ownership. So if asset seizure is not the main risk, what should long-term investors focus on? First, the structure matters more than the branding. As we discussed earlier, asset protection depends on where a fund is domiciled, how it's regulated, where assets are custodied, and where your broker is regulated, not on the nationality of a parent company. Second, the real risk in situations like this are much more familiar. Trade measures that affect company profits, increased uncertainty that leads to market volatility, and slower economic growth if global trade becomes less efficient. These are normal investment risks. They can be uncomfortable, sometimes painful, and occasionally long-lasting, but they are part of investing, not a breakdown of the system. And third, which is likely the most important part, investor behavior matters more than geopolitics. And this is where we come back to the question in the title. Based on what we discussed so far, I personally don't see a strong reason for long-term investors in Europe to exclude US stocks purely because of the current Greenland-related tensions. Not because risks don't exist, they always do, but because excluding such a large part of the global market is a much bigger decision than it may feel like in the moment. Now, it's also worth saying this. Feeling uncomfortable with a certain level of regional exposure doesn't automatically mean something is wrong. Different investors have different risk tolerances, and that's normal. What matters is why someone considers making adjustments. Changes you make as part of your long-term plan, based on diversification, time horizon, and personal comfort, are very different from changes you make reactively because of short-term political headlines. Excluding a large part of the global market is a structural decision, not a temporary tweak. And structural decisions deserve calm, deliberate thinking, not emotionally driven pressure from the news cycle. During periods of crisis or political stress, some investors step aside, hoping to avoid further pain. Others stay invested even when it feels uncomfortable. Over time, markets have tended to reward patience more often than perfect timing. Not because every recovery is fast or painless, but because productive businesses continue operating long after the scary headlines. Think back over the past couple of decades. There have been moments where the world felt genuinely unstable. Financial crises, pandemics, wars, energy shocks, and political standoffs that dominated the news for months or years. Each time there were convincing reasons that this time is different. And each time there were investors that acted on that fear. Markets didn't recover overnight. Some periods were genuinely difficult, but over time global businesses adapted, economies adjusted, and patient investors were rewarded for staying invested. That doesn't mean ignoring risk. It means recognizing which risks are temporary, which are structural, and which are mostly emotional. Whenever headlines start feeling overwhelming, I try to come back to a few simple questions. What is my time horizon? Am I investing for the next few months? Or for decades? Am I diversified across many companies and regions? Or am I concentrated on one outcome? And most importantly, would reacting to the latest news actually improve my long-term odds? Or would it just make me feel better in the moment? For me, personally, situations like these don't change my long-term approach. My wife and I have been investing via global ETFs for the past 9 years, giving us exposure to thousands of companies across developed and emerging markets. Yes, about 60% are US companies right now based on market cap, but we also own European, Asian, and emerging market businesses. We own the entire global economy, not a bet on any single country or leader. If US stocks underperform due to trade tension, that weight naturally decreases over time. That's the beauty of market cap weighing. it adjusts automatically. Our goal has always been the same: build wealth slowly by owning productive businesses worldwide, not by trying to predict political outcomes or by trying our best in market timing. Could we see more volatility ahead? Of course. Markets might react to tariff announcements or trade tensions. In fact, as of Monday morning, we may be seeing some of this already across global indexes. But volatility is the price we pay for the higher returns that stocks have historically provided over the long term. And here's what I've learned over 9 years of investing. Trying to avoid every uncomfortable period usually creates more problems than it solves. The biggest mistakes tend to come from reacting to fear, not from staying invested through uncertainty. If you're feeling anxious right now, that's worth paying attention to. Not as a signal to act, but as information. Sometimes discomfort isn't telling us that the world is ending. It's telling us that our portfolio, our expectations, or our risk tolerance may not be perfectly aligned. That's a much more useful insight than reacting to the news, because discovering your true risk tolerance during a political dispute is far better than discovering it during a deep market crash. I can't predict how negotiations will evolve, if tariffs will be imposed, or what the next headline will look like. Nobody can. And to be honest, my instinct in situations like this is often to step back from the constant news flow and focus on the day-to-day life instead. But since I'm running this channel, I want to help put things into context and keep you informed during periods of uncertainty. What I can say is that the legal and structural protections around Europe-domiciled investment funds are real, well established, and designed specifically for a world where politics and markets don't always get along. Staying informed is sensitive, but letting fear dictate long-term decisions usually isn't. If you're worried, zoom out. Look at the longest possible history you can find, and remind yourself why you started investing in the first place. You can find my favorite local brokers for ETFs linked down below, which is a great way to support me if you'd like to. As always, none of this was investment advice, just my personal perspective based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.